Welcome back to Switzer. In trying to forecast the market, we invariably try to see what's going on in the economy. But my next guest says that the stock market has a poor correlation with the economy. His name is Roger Montgomery, and he's sitting right beside me. Roger, how are you?
Peter, I'm very well. So we're going to talk about the economy and economic growth and the stock market. We're going to talk about JB Hi-Fi, but before we do,
very important.
I'm going to look down camera two.
Viewers.
I'm just telling you, producer, I'm looking down camera two. I want to say a big hello to Sarah and Ella, who are at our house having dinner tonight with their mum Wendy. Hi, guys.
Yeah. So they realise that the Switzer program is more important than dinner.
Well, you got to eat. You won't have a program if you don't eat.
That's true. That's true. Okay.
You cannot live by Switzer alone. Is that what they say?
Some people say that.
Yeah, that's right.
All right. So, Roger, last time you were on the show, you actually said, look, it's exaggerated the role of the economy in the stock market.
That's right.
Okay. And I said, well, let's come on and have an argument about it and learn something from it. What are the key arguments you're putting forward?
Okay.
By the way, he will be telling us a stock that he likes at the end.
Yes.
All right.
But so we've got to remember.
Wait for the
make sure you give me enough
debate
time.
first.
Make sure you give me enough time.
Yeah.
Only rarely does above-average growth rates in the economy correspond with above-average rates of return in the stock market. So I'll give you some statistics.
Yeah.
In the last 34 years in Australia, it's only occurred twice in 34 years.
Yeah.
And so above-average economic growth and above-average stock market returns happened twice in the last 34 years. And there are only 6 years.
2 years out of 34, you're saying?
Correct.
Okay, right.
And similarly, there are only 6 years where below average economic growth, including recessions, resulted in below average stock market returns. In fact, the study that Ashley Owen, my friend over at Philo Capital Partners, did found that at least half the time when economic growth was above average were stock market returns below average, half the time. And half the time...
Let's just pull that one and we'll think about it. So say it again.
Okay. So half the time when economic growth was above average...
Okay, so we're growing 4%. So
fast, stock market returns were below average.
Yeah. Okay.
Right? And we'll do it again. And at least half the time when economic growth was below average, which includes recessions, as I mentioned, stock market returns were above average.
Okay.
So what I thought I'd do is let's have a look at 2013... and let's see whether or not that applied most recently, whether we saw that.
Yep.
So we went through and looked in some interesting stats. So aside, there were two outliers, Pakistan and Japan. Other than Pakistan and Japan, in every single country, if you plotted them on a band, they should have gone from bottom left to top right. So if you plotted economic growth on the horizontal axis, stock market returns on the vertical axis, should be that way. Low economic growth, low stock market returns. In fact, it goes the opposite way. It does the opposite. And so I'll tell you what they are. So in 2013, for example, China had the highest economic growth and it had negative equity returns. Greece, Spain and Italy had the deepest recessions of all the countries and they enjoyed the highest equity returns. Now, the outlook, of course, is that the United States is going to grow more strongly and everyone's very enthused about that. Everyone's very excited about the fact that the United States is recovering slowly and it might start to accelerate. And so they believe that's the reason why you should be in stocks and the stock market should go up. I believe the stock market will go up, but it won't be because of those strong economic growth rates.
So now you put your argument down.
Sure. Well, these are facts, Peter. It's not just an argument. These are the facts.
They're facts that have been created for a certain argument. I'm not saying you're wrong, but I'm playing.
It's half and half.
I'm playing the viewer at home here. Remember?
Well, it's half and half. The facts say half the time it will be, half the time it won't be.
And I also think it's this, Roger, that stock markets go up not on what growth is now, but what people think growth will be in the future.
Well, yeah, I've got a counter argument to that one.
Okay, but let's just play it, because in 2009, when people started buying the stock market, it was on the assumption that, quantitative easing would work, interference of the government would work, that Keynesian approach would eventually bring economic growth. Now, we know economic growth didn't come as fast as was expected.
But, Peter, was it that? Or was it that stock prices were just so low that they were pricing themselves out of business, and the fact is these companies were still making profits?
Yeah, and I would say there are multiple variables that explain why stock prices go up. But I don't know whether the analysis that's been shown so far destroys the belief. And this is,
I've got a solution, by the way.
Okay, but
I've got something better to watch.
Okay, good. Undoubtedly you would, but I don't think you can. What the charts that I've seen too. I've done. And I found the charts heading in the wrong direction as well. But no one can destroy the argument that if, for example, the Australian economy grows strongly, and then retail sales really improve,
yes,
that the profits of David Jones and Myers won't improve, and
well, now
therefore,
you're talking about something else.
Yeah, and then
right?
the share price.
So it's not the macroeconomic situation. You're talking about how that macroeconomic situation impacts individual businesses,
profits, earnings, and
that's
share
what,
prices.
and that's the important thing I want to tell you.
Yeah.
So, give you an example. Between 1964 and 1981 in the United States, the US economy grew 17-year period, 1964 to 1981. It grew 377%. Now, in the following 17 years to 1998, the US economy grew 170%. But in the first period where it grew much more strongly, the US Dow Jones went up 0.1% in that 17 years.
Yeah.
And in the second period, it went up over 1,000%. So it went up more than tenfold in the second period. So it's not economic growth. Now, what happened in the first 17-year period compared to the second 17-year period? In the first 17-year period, interest rates went up, and corporate profits as a percentage of GDP, as a percentage of the economic pie, went down. In the second period, interest rates went down, and corporate profits as a percentage, as a piece of the pizza, went up. And that's what we care about. It's all about profits and interest rates. So at the moment, we're going to see, I think, particularly for the companies that we have in the Montgomery Fund, we're going to see very, very strong growth in earnings. And so that's going to drive share prices.
Interest rates going to be low,
provided interest rates stay low. Now, if interest rates spiked, and they spike dramatically, we don't care about normalisation, but if they spike dramatically, that might put a cap on it. But I don't think we're going to see that.
Well, the important part, if people have endured this academic debate we've had, the important take-home message is that you're virtually saying you think this bull market we're in now has probably at least another 2 years.
That's my belief. Now, I rarely stick my neck out because I think there's no reward for getting it right. No one remembers it.
Well, yes, I will.
I will. Get it wrong. You'll remember it. You'll call me up on it. Well, so far the track record's been pretty good.
I'll applaud you and I'll criticise you. That's the deal.
So I actually think what's going to happen is that we're going to see, save for a huge steepening of the yield curve in the United States, we're going to see steady, plodding growth in the US. That's what we want. We don't want fast growth in the US because that'll be a disorderly unwinding. And so the companies that we've got are growing. Ainsworth has said, Ainsworth Gaming Technology has said that they're expecting growth in profits of 50%.
And they have a lot of exposure to the US as well?
They have exposure to the US, and people are worried that because the economy is not growing as fast, people aren't going to play poker machines, but they're coming from a low base. So, any incremental increase is a dramatic change in the number of machines that they've got rolled out. Okay, I don't want to talk about Ainsworth. I want to talk about a different stock.
So I said to Roger, given the fact we're going to be debating this, make sure my viewers at least get a stock at the end of it. So which one is it?
So it's JB Hi-Fi.
Which you've talked about before.
Which I have talked about before. We do own it in the funds.
Okay. What target have you got?
The reason why, look, we think it's worth about $22.50 to $23.
What's it
It's
now?
about $21. Close to, I think today it was up 4%.
So if you got $2, you make 10%.
So, look, but the reality is, there are a lot of other companies out there that we think are absolute rubbish and they're expensive. So this is a company that we think is good quality. NPAT margins increasing, gross profit margins are increasing. That was slightly offset by cost of doing business increases. But here's the interesting thing, their home rollout, they're rolling out appliance stores and fridges and freezers and whatever. That should break even this year and should make a profit in 2015. Jerry Harvey told me that it wouldn't succeed, and that seems like it's working reasonably well. They're at a 10% discount to our estimate of intrinsic value. And here's the interesting thing.
So you're saying with all the market price is lower than intrinsic value?
It's lower than our estimate of intrinsic value. And there aren't many high-quality businesses that we can say that about at the moment. Despite that, that I think the ones that are fair value are going to keep rising because earnings is going to lift and the intrinsic value will rise by a good clip. But what's interesting about this business, think about the activity we're seeing in auctions at the moment. I saw an email go around today. We're in a super boom with respect to auction activity in Australia. Okay. And we know what's happening in the property
real estate
market.
Auctions you're talking about.
Real estate auctions. People have to, when people move house, and a large proportion of them are investors, but when people move house, they deck it out with new stuff.
Yeah, of course.
They get new plasma tellies and whatever.
Well, and Jerry says there's going to be a curved screen TV coming too. It's going to be huge.
Oh, whatever. I mean, last year was talking about the 100-inch, which we've got behind us, right? You know, these massive...
Oversupplied.
You know, so and the prices they're not expensive, they're affordable and achievable. People are going to buy them, they're going to put them in their houses.
What do you think of Dick Smith?
Look, I spoke to someone...
when it floated, didn't you?
No, we were a bit nervous about it. We thought it was okay, but we didn't like it. But I did speak to someone yesterday who really, really likes it.
Yeah. I met the CEO, Nick Abood. He's pretty impressive. Yeah,
and he is impressive. For me, the issue is, well, where's their share of mind? Yeah, and for me, they don't have a great share of mind.
What's that mean?
Well, when you're thinking about... So if I said to you, Walt Disney...
Yeah.
You immediately conjures up. Everyone watching immediately knows they're going to think about, Tinkerbell, or they're going to think about the Dalmatians, 101 Dalmatians. You know, if I said to you, I'm just trying to think of another Tribeca movies or Tribeca production, you know, you're sort of thinking, hang on, I haven't even heard of them. So that's share of mind. And so when I say JB Hi-Fi, it's got a bigger share of mind than Dick Smith.
So they need an effective marketing campaign?
Probably.
Yeah, okay, good. Any other companies that you're watching?
We really like, absolutely. Look, we really like Seek. It's been expensive on traditional measures.
It came down this week, didn't it?
And we bought some more. Yeah. So we really like that company, and we think it's going... Look, in the short run, it's probably fair value, and that means and because the PE is high and everyone else follows PEs, we don't. So it's got a higher beta, so it's more prone to sell-offs. But we believe very strongly that it could be worth double or triple its current share price in 5 or 10 years' time.
Buy it on the dips.
Correct.
All right, mate. Thanks for joining us on the
Pleasure, Peter.
Time always goes fast when we have fun. That's the show for tonight. Thanks for joining us, and I'll see you guys next week.